Wall Street's greatest crash, the hidden pattern that wiped out 89% of wealth, and why it's happening again. October 24, 1929. Panic grips the New York Stock Exchange. The ticker tape, hours behind, spits out ruin. Fortunes built over a decade vanish in minutes. Outside, crowds gather in disbelief. This isn't just a bad day, it's a total system failure. In weeks, the market loses twice the US federal budget. By the end, 89% of value is gone. The Great Depression begins. But this catastrophe wasn't random. It followed a clear, 7-stage pattern. That pattern is repeating today. The 1929 crash is often told as a sudden shock, but the storm had been building for years, marked by distinct stages. Each stage seemed logical, even prosperous, but added instability. Understanding these stages isn't just history, it's a warning. The same forces and illusions are at play right now. Tonight, we'll reveal the 7-stage pattern, from the post-war boom to the devastating collapse. We'll show how ordinary people, financiers, and institutions built a house of cards. The parallels to today are undeniable. According to our analysis, we're already deep into this cycle. We are in stage 5. The clock is ticking, and history's lesson is urgent. Financial history is a cycle of booms and busts, tulips, dot-coms, housing. Each feels unique, but a repeating blueprint emerges. A 7-stage pattern, a financial law of gravity. It starts with real economic change, sparking optimism and wealth. But optimism turns to excess. Easy money fuels speculation. New tools make borrowing and gambling effortless. Prices rise and the illusion of endless prosperity takes hold. Each stage flows logically, feeling like a path to riches, not ruin. Stage 1. Real innovation. Stage 2. Easy credit. Stage 3. Mass speculation. Stage 4. Financial engineering. Stage 5. Dangerous interconnection. Stage 6. Smart money exits. Stage 7. Collapse. The 1929 crash is the purest example. Post-WI growth sparked the boom. The Fed's easy money fueled it. Millions joined the market. Margin loans and investment trusts created massive leverage. The system became a fragile web of debt. The crash wasn't an accident, it was inevitable. The pattern's danger is psychological. As prices soar, belief in a new era becomes unshakable. Skeptics are dismissed. The media amplifies the hype. Overnight millionaires become legends. Euphoria creates a feedback loop. Rising prices justify speculation, which drives prices higher. It's seductive and destructive. This same force is building in our markets today. The blueprint is set. The pressure is rising. The 1929 crash began with a boom. After WWI, America entered unprecedented expansion, the Roaring '20s. New tech, cars, radios, electricity, transformed life. Ford's assembly line built a new middle class. Optimism swept the nation. America was the world's creditor. This was stage 1. Real economic growth. Factories thrived, wages rose, and the stock market reflected true prosperity. Early investors made sound decisions. But beneath the surface, government policy set the stage for danger. The Federal Reserve lowered interest rates, making borrowing cheap, pouring gasoline on a healthy fire. The government's hands-off approach left Wall Street unregulated. Prosperity, cheap credit, and lack of oversight created the perfect bubble. Low interest rates and easy credit changed investing forever. Stage 2. The stock market became a national obsession, a shortcut to riches for all. Stories of everyday people striking it rich fueled the frenzy. Banks and brokers opened offices everywhere, marketing stocks as lottery tickets. The radio broadcast stock tips into every home. The market was everywhere. Corporations lent money to speculators instead of investing in their businesses, fueling a shadow banking system. The engines of the real economy now stoked financial speculation. As prices rose, risk seemed to vanish. The logic of the bubble took hold. The fever was supercharged by margin buying. Stage 3. Investors could buy stocks with just 10% down, borrowing the rest. For every dollar invested, they controlled $10 of stock. Gains were spectacular until they weren't. A clerk named John puts in $1,000, controls $10,000 in stock. If prices double, he's rich. If they fall 10%, he's wiped out. Margin calls forced investors to sell at losses, triggering more selling, a vicious cycle. By 1929, margin lending exploded from $1 billion to $8.5 billion, more than all U.S. currency in circulation. The market's value was built on debt, not cash. The structure was fragile. A small drop could trigger catastrophe. The illusion of wealth was vast, but paper thin. The system was primed for collapse. Leverage magnified both gains and losses. The public believed in endless prosperity, but the risk was hidden in plain sight. Wall Street's engineers added more risk. Stage 4. Investment trusts. These trusts let small investors diversify, but added layers of debt and leverage. By 1929, 1 in 5 investment dollars flowed into these trusts. Trusts like Goldman Sachs Trading Corporation created pyramids of leverage. Trusts owning trusts, all built on borrowed money. Investors used margin to buy shares in leveraged trusts, multiplying risk. The system became opaque and incomprehensible, even to experts. Investors saw rising prices and assumed safety, unaware of the house of cards beneath. When the market turned, these trusts collapsed, wiping out fortunes. By summer 1929, the system reached stage 5 total interconnection. Risk spread everywhere. Banks, corporations, savers, all tied to the market. A factory worker's savings were at risk because his bank lent to Wall Street. The chain local bank to New York bank to broker, to speculator, to investment trust to corporations. Everyone's assets depended on this fragile chain of debt. The system was no longer resilient. A single failure could bring it all down. Like a Jenga tower, the structure was unstable. By 1929, the risk was systemic and hidden in plain sight. Today, in 2025, we face similar dangers: record debt, complex derivatives, and global interconnection. Financial products link institutions in ways even experts can't fully grasp. Belief in central bank safety nets breeds complacency. The warning signs are flashing. Summer, 1929. The public is euphoric, but insiders see the danger. Stage 6. Sophisticated financiers quietly sell. They see profits flattening, production slowing, and valuations detached from reality. Joseph Kennedy and Bernard Baruch liquidate their portfolios. Insiders sell discreetly, trading paper wealth for cash and gold. The public keeps buying, mistaking stability for strength. This is the calm before the storm, the moment of maximum risk. The market forms a plateau. Insiders exit, amateurs buy. In September, the Dow peaks, then drifts sideways with volatility. Small drops are seen as buying opportunities by the public, but as final exit points by insiders. The trap is set. The supply of new buyers is exhausted. The market has only one way to go down. The stage is set for collapse. The end came fast. Stage 7. Unraveling. October 24th, Black Thursday. A brief rally offers false hope, but selling overwhelms the market. Margin calls force thousands to liquidate, triggering a vicious cycle of selling. October 29th, Black Tuesday. Panic grips Wall Street. 16 million shares trade as prices collapse. The ticker tape can't keep up. Investment trusts are wiped out. The web of debt unravels in days. The crash didn't cause the Great Depression, it exposed the rot. The 7-stage pattern is relentless. Real prosperity leads to easy money, mass speculation, leverage, interconnection, insider exit, and collapse. This is a story as old as markets. Today, November 6, 2025, the parallels are stark. Decades of easy money, mass speculation, complex derivatives, and global interconnection echo 1929. We are in stage 5. Evidence shows smart money is moving to hard assets while the public chases highs. The crisis logic is already in motion. History doesn't repeat, but it rhymes. The rhyme is shouting a warning. The blueprint is clear. The lesson is urgent. Will we listen this time?